Hello and welcome everyone. This is Trading Options Around Earnings. My name is Sean Howell. I'm a senior strategist with Investor Education here at eTrade, and I'll be your instructor for this session. Thanks for joining. Before we get started, just a couple of quick points. When I'm doing presentations like this, I always like to incorporate some real-world examples, and I've done that in this case as well. Just keep in mind, I'm selecting those examples because I think they really do a good job of illustrating the points. In no way am I making any recommendations by using those examples, so keep that in mind as we go through this session. So the goal for this session is I want you to understand a lot more about volatility and how volatility relates to some earnings strategies. As you can see here, there's a number of strategies around quarterly earnings. If you have an opinion, if you feel that because of an earnings announcement you're going to see the stock rally, it's pretty simple. Really, you're looking for bullish trades. You're looking to buy calls. You're looking to sell puts. Or if you have a bearish strategy, same thing. You're looking to buy puts or sell calls. It's when you don't really have an opinion of the direction that the stock is going to take post-earnings or even pre-earnings is when we start getting into a little bit more of the volatility-based strategies. So although this presentation really kicks off talking about volatility, it's important that you understand the basis of how options are priced, historical and implied volatility as we get into the actual strategy selection here. So that's my goal, for you to understand volatility and the relationship of volatility to earnings and to be able to pick some strategies that you're comfortable with. So the agenda for this session is we'll go through and define and measure volatility. Again, that's a very critical component around trading for earnings. And then we'll get into relating volatility to options pricing. And then finally, we'll get into talking about some of those strategies where I'll go ahead and pull in some real world examples here. And hopefully you'll find those to be compelling. So let's define and measure volatility. The first bullet point is volatility is the degree to which price of a contract tends to fluctuate over time. Okay, what exactly does that mean? That really means the difference between the high point and the low point of the trading range, and that can be for a number of minutes, it can be for a number of hours, it could be for a day, a week, a month. So it's really just how wild of a ride is the roller coaster that you were thinking about getting on or you are currently on. Second bullet point, it's a statistical measure of the dispersion of price for a given security or market index. So we can look at volatility for a security, for an exchange-traded fund, or an index, and we can visualize that to see just how wide those swings have been. Now you can see that when you look at a chart, especially if you're looking at a candlestick chart, but you can also quantify that as well. So we'll be using that number and the range in order to determine sort of where we're at in the range of volatility, possibly where may we be going, and where may we possibly reach an apex or a fulcrum on that as well. It's measured as one standard deviation, and when you're looking at a one standard deviation move, if you're looking at a one standard deviation move on each side of the current price, generally speaking, based on historical behavior, the market tends to stay within the one standard deviation move 68% of the time. Now, that's looking back at historical volatility. And I know I haven't defined historical volatility just yet, but as I get to that point, you'll understand why we can start to assign certain probabilities for being successful or for failing on specific trades that we set up, because again, we can quantify this based on standard deviations. Fourth bullet point, commonly the higher the volatility, the greater the anticipated move. Volatility is not always a measure of risk, but because it is a measurement of the potential or the anticipated move, people look at that as both the risk, but you can also look at that as the possible reward as well. Volatility is not a directional measurement. It's just trying to quantify the expected move, and you'll see as we get into some of the numbers here on that as well. So there's two types of volatility. You'll hear me talking about this probably as vol for short as we go through this. On the left-hand side in green, there is historical, sometimes referred to as statistical volatility, often just abbreviated as HV or SV. So historical statistical volatility is backward looking. It's something that we can observe. We can observe it in a chart. We can quantify it. We can see that it has happened. So it's history is what it is. And it's a key component of the Black-Scholes model, which is an options pricing model. Now, that options pricing model, we can plug in all of the known things about an option. We can price in its current price. We can price in days to expiration. We can price in the current interest rate, and we can price in the historical volatility. And once we put all of those components in, the Black-Scholes model is going to give us a price. From that price, we can compare that theoretical price to the current price. And therefore, we can say, hey, the current price of this option is pricing higher, or it's overpriced than its theoretical model, or it's underpriced. And where people will utilize this is they'll say, hey, this thing is overpriced. As such, it's going to eventually correct itself and it's going to come back to that theoretical price, so I may want to consider selling. Or if it's underpriced from the theoretical model, then people may consider buying that option, and as it tends to revert back to the mean, that it's going to go ahead and make you money as you'll be buying low and selling high. Now, the problem with using historical pricing, or I should say historical volatility and pricing models, is it's looking at what something has done historically, but it is not looking out into the future as to what may be going on that is different, looking out a week or two or a month than what happened over the past couple of months or couple of years. So let me give you an example here of the difference between historical versus implied volatility. Let's say that you are thinking about trading a pharmaceutical stock, and for the past 5 years they have been working on some kind of drug that may or may not cure something like Alzheimer's. If we just look at the historical volatility of that, where they haven't done any kinds of tests whatsoever, we're going to be given a number, and that number can be plugged into the Black-Scholes model, and it can give us a fair price, if you will. But what if we know that next week this drug that they've been building for 5 years, and maybe they've been testing it for the past 3 years, they're finally going to release the results of those drug trials? Would you think that option pricing model is going to accurately price options based on what is happening next week? And hopefully you're saying absolutely no way, because nobody knows what the outcome of those drug trials are. But the outcome could be, let's say, one of 3 things. They could be conclusive in that it is helping people, and as such, if it is helping Alzheimer's patients to improve, that could create a dramatic upside movement to the stock. It could double, it could triple, it could quadruple as a result of that positive study being released. Or the other thing, it's also conclusive, and it's conclusive that it's doing no good at all. Maybe it's doing more harm than good. As a result of that, the stock price could collapse. It could get cut in half. It could go, well, theoretically, it could go all the way to zero. So that's where we get, or I should say the third thing is that, or it could be inconclusive, in which they need more data, they need more time, or somehow the study was not a clean study, so they need to do it again. In that case, then the stock doesn't really have enough data to know to move up or down in that case. So that's where historical volatility in the models do not really pan out. We need to think about the implied volatility instead. Now, implied volatility is going to be driven by market forces. It's going to be driven by supply and demand, the number of people that are willing to sell calls or sell puts beyond the obligatory side, the number of people that want to buy calls and buy puts. They're demanding. And when you've got something, going back to my example, like a pharmaceutical study that's been in the works for 3 years and the data is going to be released next week, you have a huge buildup of people that don't want to take positions because they want to reduce their exposure to risk, their equity exposure. So therefore, they're going to turn to what we're learning about today. They're going to turn to calls and they're going to turn to puts. So because of that, you have this increase in demand and you typically have a decrease in supply. So therefore, when we have an event, it's called a binary event. When we have an event on the calendar that we believe that the market is going to behave in a more volatile manner, option prices tend to go up. They tend to spike. And that is exactly what we anticipate happening around earnings, is that we expect an increase in the implied volatility to exceed the historical levels. So let's get down to the second point. Implied volatility is forward-looking. It can be predictive. That doesn't mean it's going to predict accurately, but it is giving you an indication of what the market thinks could happen. Let me give you an example. We've got a stock that is trading at 100. And there's nothing going on in the news. The stock is just doing what it's doing. It's trading at 100, and we look at the $100 call option that's out 30 days, and it's trading at $1. Okay, that means that someone is predicting, if they were to buy that option for $1, they're predicting in 30 days that stock is going to be higher than $101. If they weren't predicting that, then they wouldn't pay $1. They're predicting it's going to be higher. So they think that the volatility is being understated in this case. And the put, let's take the same example. That $100 put that has 30 days to expiration is also trading at $1. Well, the person that buys that is therefore predicting that the stock on day 30 is going to be lower than $99. Now, take those examples here where we've built in a volatility of 1% over 30 days. We'll keep everything simple here. Let's then say that as we get closer to earnings and that 30-day period would encapsulate earnings. The previous example did not encapsulate earnings. But now that a couple of weeks have gone by and the stock is still at $100, nothing has changed with the price of the stock. But that 30-day period now encapsulates an earnings event. So we think, wow, now I'm going to go check out prices. Surely they haven't changed because the stock has not changed and I'm still looking at a 30-day option. But yet you go look at the $100 call option and it's trading at $2. And you look at the $100 put option, it's trading at $2. Why? What happened? Supply and demand. The implied volatility has gone up, and now the implication is by the people that are buying these calls and puts is that, hey, over the next 30 days, this thing is going to either be up 2% or it's going to be down 2%. So now we've seen the effects of implied volatility on option pricing without anything else changing here. Okay, so let's go ahead and take a look at an example here. So here's an implied volatility example, and I went ahead and pulled up Tesla on this one. So a couple of bullet points real quick. Remember, implied volatility is the result of demand for options. It's the buying pressure that is driving it up. It's expressed annually as a 1 standard deviation percentage move. So even though we may be looking at an option that is only containing 1 week, that has been annualized, kind of like if you were to look at a 3-month CD. That 3-month CD may say that it's paying you 1.5%. It's not paying you 1.5% over 3 months. It is paying you the equivalent of a 1-year APR annual percent rate. Same thing when we're looking at a standard deviation, so we can compare everything. They have been annualized as far as the implied volatility goes. Okay, third bullet point. We can compare the historical volatility to determine whether the current price of the option is overpriced or underpriced. But again, historical volatility is just that. It's based on the Black-Scholes model, it's based on the behavior, and it is not forward-looking. Fourth bullet point, implied volatility is forward-looking. It gives us the prediction, if you will, of what the market thinks could potentially happen. Again, not directional, just trying to give us an idea of what the potential range could be on that stock within that period of time. Okay, so I'm looking at Tesla, and you can see I'm on Power E-Trade here. You can see there's an E next to Tesla Inc. Com. That indicates that there is earnings within the near future here. So sure enough, I took the screenshot January 28th, and the earnings were coming out after the market closed on January 29th. Now, what I want to point out about this here is I want to point out that as I'm looking at the option chain, you can see down below I've got options expiring January 31st, February 7th, February 14th, February 20th, so on and so forth in the Power E-Trade option chain. By the way, this right here is called the Constellation, and you'll find it just below the price there. It'll look like a little mini chart. Okay, notice that red line there. We've got the implied volatility of the January 31 option up here at about the 150% level. So, wow, there is a ton of implied volatility speculation built into that. Relative to that 80% down there on the bottom red arrow, that is indicating the 30-day average. So now that we're within that window of earnings, people are really willing to pay extremely high prices. They're willing to buy this as if it was expected to move over 150%. So I know that the options are extremely pricey relative to how they should historically be priced. So the market is anticipating a very big move. Now the question is the market over predicting a move or under predicting a move? And we'll get into that as well. Now notice as we go further out in time, as I look at the February 7th option and I look at the February 14th option, that the implied volatility for the further out strikes is lower. And the reason why is that as people are demanding to buy these options, so they can capture the earnings announcement, they really don't want to buy more time than they need. So since the earnings are coming out on January 29th, people say, well, January 31, that would encapsulate earnings. I don't need to go buy the February 7th option, although some people did, because you can see that the implied volatility there is still at 100. But go all the way out to, let's say, March 6th, where you can see that the option is sort of back to its normal pricing. You know, that's something to think about as well, is that you don't need to buy that January 31 and really pay a lot to encapsulate it. You could go out and buy the March 6 option, which really, even though it's more time, you are not paying this huge premium for the implied volatility. It would be more money because it's more time, but when it comes to the volatility side of this, it's more normalized. Far more normalized than the January 31st option. Okay, and don't worry, we'll be going back to Tesla. That's one of the examples that I'm using here. Okay, so let's get into relating volatility to options pricing here. So we'll slow things down a little bit here and go back to the historical volatility thing. So I'd like you to consider 3 different stocks. And those 3 stocks have different historical volatility. So we're going to normalize everything else about these 3 stocks except for their volatility. So here's the stock that's in black. And that stock has gone from $20 to $50. Okay, that's going to be one of our bases. And then here's the stock with the purple line that has also gone from 20 to 50. So the price performance is the same. They both went from 20 to 50. And here's the third one here in the green line. All 3 have gone from 20 to 50. But they did it in 3 very different manners from a historical volatility perspective. Obviously, as you can see visually, the black line had the lowest volatility and the purple line had the greatest amount of volatility as it rose from 20 to 50. If we looked at the premiums, the 1 month at the money call premiums, and by the way, put premiums would basically be the same here. And we were trying to understand the differences. If they've all gone from 20 to 50, then why is option A, that call option, priced at 50 cents, option B priced at $1, and option C priced at $1.75? And that is because of the historical volatility. The more historically volatile a stock has been, the higher the option is going to be priced. And you can see that here. Price performance is exactly the same, but the behavior is going to be different, and that gets priced into things. So as people say, hey, we've got this XYZ.com stock that's about to release earnings next week, I'm thinking about taking a position in there. Well, if historically it's been very volatile, and next week is earnings, you're going to have a combination of high historical volatility and probably a combination of high implied volatility as well. So it's going to be an expensive option for you to trade. Now, you don't have to necessarily chase high implied or high historical volatility options. You could take more contracts even if it had low volatility. So think about that as well. Okay. Now let's talk about the implied volatility and how the pricing of options can change a little bit. And so it's very difficult to watch this kind of thing in real time because you've got time decay going on, you've got the underlying stock going on. So I created a little bit of a timeline here to walk you through some typical expectations about how option pricing would change as we get as an event comes up, and as we pass through that event as well, something like what we're talking about today, which is earnings. So let me explain what I've got here. We're going to look at timeline, we're going to look at the stock price, we're going to look at the changes in implied volatility, the changes in call price, and the change in put price. So here's what happens. Stock's just doing its thing, and the CEO tweets, hey, press conference next Wednesday after the market close. Now, is that good news or bad news? Well, it's neither. When I wrote this, I wrote it very intentionally to not sound like this was good stuff or bad stuff. It's just saying that there is going to be information released at a press conference next Wednesday. So based on that information, what happens to the stock price? Well, that information doesn't tell you anything at all. So what I'm suggesting here is that the stock price goes nowhere. Stock price stays flat. But now that we know that there will be a press conference next Wednesday, people say, oh, I'll bet that's going to be good news, or oh, I'll bet that's going to be bad news, or oh, that's going to be news, and that news is going to drive movement. And because of that, us option traders decide that we want to go take a position, and we take that position by either buying calls or buying puts or selling calls or selling puts, but regardless, we start to take positions. Because we're taking option positions, there's an increased supply, if you will, as most people are generally buying options versus selling options. The implied volatility goes up. Now, the stock price didn't go up, but the implied volatility goes up, which means that the call prices go up and the put prices go up. So an expansion in implied volatility is going to increase both call pricing and put pricing as well. And that's all happening because of the anticipation that something is going to happen at this press conference next Wednesday after the market closes and people take positions on that. Think of this as an earnings, but earnings are known. I wanted to have something sort of just come out of thin air that was not known. Now it's known, and now we can call this a binary event. It's something we can put on the schedule and we can trade around. Okay. Unfortunately, though, as we get closer to the event, the CEO, let's say it's the day of the event, the CEO tweets out to everybody, hey, sorry, I got food poisoning. I got to postpone this event till next Wednesday. Now, as a result of this tweet, it just means that the information that was going to be released at the end of the market on that Wednesday is going to be a week off. And that means that people that were buying the options that expired on Friday, well, all of a sudden, what they thought was going to happen is not going to happen. So here's what happens. The stock price doesn't have any reason to change. It just stays the same. The implied volatility, however, though, drops because now the people that bought the option that expires Friday, anticipating that would encapsulate Wednesday's press conference, right? The implied volatility vanishes. This is called a vol crush, by the way. The implied volatility vanishes, which drives the call prices down and the put prices down. But the option that expires a week and a half from now, the implied volatility shifts into those. So the call prices and the put prices for those go up, while the implied volatility for this week's dramatically go down in a vol crush. Now again, the price of the stock has not changed, but the option prices are moving all over the place as we have these tweets coming out. Okay, let's push forward to that next Wednesday conference call, press conference. Well, the company unveils, hey, limited edition in 2 new colors coming soon. Wow, that's not really big news. The market thought there was going to be some important news, but it's just colors. And I'm kind of joking about this, but I have seen press releases where someone just says, oh, hey, we're going to release a new car in 3 years, or hey, we've got this phone in red now. And the market is a big, who cares? That wasn't interesting at all. So here's what happens. The stock price goes down. Oh, 2 new colors? That's it? Stock price falls on this lack of good news, I guess you could say. Implied volatility, of course, that comes down because now the news is out. So there's nothing more to trade on. There's nothing anticipated here. Now, what I want to show you here in my poor graphic abilities is that because the implied volatility came down and because the stock price came down, the call option comes down hard. So it falls not just because the call option falls, not just because the stock price was coming down, but also because of the vol crush and the volatility basically evaporating out of the call option premium. Now, the volatility implied premium in the puts also came out of the puts. So if you had puts on this position and you saw the stock price fall, you may say, awesome, I'll bet my puts are really rallying strong. But you go look at the put prices and you find that they're not really rallying. They are going up, but it is to a lesser degree than you would have thought based on the drop of the stock price. And the reason for that is so much of the options value was juiced up because of the implied volatility. So although you got the direction right, you did not make the money that you had anticipated because of the built up implied volatility as this simply reverted back to the mean again. And you'll see how this plays out as we get into that Tesla trade that we sort of built up here a little bit. So let's get into strategies for using options around earnings. And there's really 3 strategies, three things that I want you to think about incorporating into your strategy. The first one is that implied volatility often expands as a binary event approaches. And we just saw that with the previous example. As we get closer to that event, generally speaking, the implied volatility is going to expand. So it generally expands as we get closer to the event, and then it contracts as that event concludes. And again, that's called a vol crush. That volatility usually will evaporate because people were all demanding to buy more options because of what they thought was going to happen right around that event. Second point, volatility typically reverts to the mean. So when the implied volatility is high in the historical volatility range, and I'll show you how we can do that, the trader says, wow, we're way up here at 160. I don't think we're going to stay up here at 160. We're going to get back down again towards sort of its average range here. So right now in the markets, we're looking at a VIX of about 40. That is the overall volatility for the S&P 500. So if the VIX is at 40, but it's generally between 15 and 20. If it's at 40, what a trader would be expecting is, hey, I expect that this thing is going to revert back to the mean in this case. So when implied volatility is low in the historical range, they expect it to expand. So when we saw the VIX down at like 10, people would say, well, this would be a good time to buy calls and puts, as it probably won't stay down here at the level of 10. It will probably revert and expand back up to that 15 to 20 range. And the third thing is that implied volatility usually overstates versus what it actually does. Now, there's an important thing to think about here. The reason that it usually overstates is to get somebody to sell a call option or sell a put option. There has to be something in it for them to take the obligatory side of that trade. And what's in it for them is that usually people are wrong. So go back to my example of the stock that's coming up to earnings and the call option is trading at $2 and the put option is trading at $2. If I'm thinking about selling a call option, what I'm really saying is if I sell you a call option, it's got to go up 2% before I'm losing any money at all. So I would sell it to you if my belief is it's going to go up less than 2%. And your belief is I'm paying $2 for the $100 call option because I think it's going to go up more than 2% or more than $2. Well, someone's going to be right and someone's going to be wrong. Generally speaking, implied volatility is usually overstated, because if I was the person selling the option, taking on those obligations, and I was wrong all the time, I'd stop, and I was losing money all the time, then I'd stop selling those things. And if people aren't selling these things, well, you got to get somebody to sell it. So what do? You offer more money. So generally speaking, it's overstated versus the actual or realized volatility of that. So let's talk about how the expansion and contraction of implied volatility affects the option pricing. And we're going to look to one of the Greeks here to understand how much money we could make or lose depending on the changes of volatility, and that's called vega. And vega is the expected change in an option's value with respect to a 1% change in volatility. So go back to that Tesla example. That Tesla example was trading with a volatility upwards of 160. If the average volatility was 80 in that, then we could say, wow, this thing is really, really very high. And if I expect that it is going to revert back, it is going to lose 80 percentage points. It's going to go from 160 all the way down to 80. So that's 80 percentage points. Granted, that's a 50% drop in volatility, but be able to distinguish the difference between a 1% change in volatility versus the percentage move. Okay, so a couple things to keep in mind about vega. Vega is highest for an at-the-money option. At-the-money call options and at-the-money put options have the highest vega, therefore they are the most sensitive to changes in volatility. If you expect that volatility is going to expand, then you would want to buy the options that are most sensitive to that expansion. That would be the at-the-money call or at-the-money put. If you expect that volatility is going to contract, then you would want to sell the at-the-money call and the at-the-money put, as they are going to be most sensitive to the move. And vega is also lower near expiration. So when we're looking at short-term options versus long-term options, the short-term options are going to be less sensitive than the longer-term options. Okay. So the inputs into the Black-Scholes model, so we can go ahead and calculate something. Oh, by the way, on the right-hand side over there, I'm just showing 3 different stocks and showing their implied volatility change. So for example, the middle one there, which has a current implied volatility of 62.36, that implied volatility change is 57.96%. That is not a 57-point change, but it is still a very significant move here. That would mean basically that the implied volatility has spiked due to some big move here. Okay. Let's get back to the fourth bullet point, inputs into the Black-Scholes model. We're going to take a $100 stock price and a $100 strike price. So these are at-the-money options. And we're going to take 100 days to expiration, keeping everything really simple, and a 1% interest rate. All of those are requirements to input something into the Black-Scholes model. And a 1% interest rate. The vega on this option is calculated by the Black-Scholes model, a hypothetical options pricing calculator, at 0.2113. Now, what does this look like? With the volatility currently at 20, that means that a call option should be priced at $4.37, and a put option should be priced at $4.09. If I take the volatility and nothing else changes, let's say that time doesn't change, the stock price doesn't change. The only thing that changes is that volatility goes from 20 to 21. So it goes up 1 percentage point, which is a 5% move. Again, I want to distinguish those two. It goes to 21. So volatility, you bought it, you bought the call, you bought the put, and then volatility goes from 20 to 21. How did that affect the prices of the options? Well, you can see it enhanced them both. Because the call option went from 437 to 458, you'll notice that is the vega. That is a 21-cent move. But the put option also went up from $4.09 to $4.30. So the expansion in volatility doesn't necessarily give any idea of the directional move. It helps to understand how calls and puts become more valuable as volatility expands. Well, let's take the same example and say, but then volatility contracts. It contracts from 21 back down to 19. So that's a 10% move, but a 2 percentage point move. Look at what happened to the call option. It went from 458 down to 416, and the put option went from 430 down to $3.88. So the movement is something that we need to consider when we are thinking about our option strategy. So let's get into that. Let's start with a volatility expansion concept. When do we anticipate that volatility is going to expand? Well, as we get closer to that event, to that binary event, excuse me, as we get closer to that event, it would make sense, but it's not always the case, but it would make sense that as it gets closer, that options people begin to, I guess you can say, place your bets. They begin to take positions by buying calls and buying puts. So if we were to go into Power E-Trade, and we were to go into markets, and then we go to calendar, we can look at the earnings announcement calendar, and I can look for stocks that I think are going to react in a bigger way to an event like earnings when it comes to implied volatility. So I'm looking at Twitter. Well, Twitter historically has been a pretty volatile stock, and also because of the nature of the company. Because they're not really a bricks and mortar kind of thing, they're also very sensitive to earnings announcements. Are they doing well? Are they improving? So on and so forth. It's not like a utility company. This is, after all, I guess you could call it a .com. It's Twitter. So we know that we've got Thursday the 6th. We know that Twitter is going to be releasing earnings, and that's going to be before the market. So people may want to trade around that. So the idea would be, if you do not anticipate a directional move, but you do expect a expansion of volatility, you could trade around that. So here's a volatility expansion tactic. Consider buying contracts ahead of an event in anticipation of an expanding implied volatility. That is going to increase the option premiums. Now, here's the thing to think about. Since this is not a directional trade, price direction, this is a volatility directional trade, you might want to think about closing the positions prior to the actual event. Because if you think about it, when is implied volatility going to be at its highest level? Well, the idea here is just before the company has their announcement. Now, if that's after the market, then you may want to consider closing the position prior to the actual event. If it's the next morning before the market even opens, then you'd want to consider closing it out the day before. So when we're looking at Twitter here, and remember that implied volatility, or I should say Vega, is highest with the at the money option. So let me go back here. So Thursday the 6th is when this option is going to release. So if I were to buy the February 7th option, excuse me, if I were to buy the February 7th option, that would encapsulate earnings. Therefore, I believe since this is the closest expiry that encapsulates earnings, that this is the one that should have the greatest expansion of volatility. And because I know that Vega is greatest with the at the money option, and the stock is currently trading at 33.73, I'm going to go ahead and think about strategies around the expansion of volatility. Those strategies can be, I could buy a long call if I'm bullish, or I could buy a long put, or I should say, I can have a long put by buying a put contract if I am bearish, or I could buy a long straddle or strangle. A straddle or strangle is really that you are buying both the call and the put because you believe that the stock is not going to take a direction prior to earnings. So that's what I've built right here. I've built a strangle, and I am buying the February 7th 34 call option And I'm also buying the February 7th 33 put option. So I'm buying a slightly out the money call and a slightly out the money put. And I'm paying for that $2.99. By the way, this is also considered to be predictive. The market is expecting that Twitter is going to move about $3, so about 8% between the time that I put this trade on to February 7th. That's one of the ways you can kind of see what the market is predicting, if you will, the movement here. Now, again, we're not gonna be in this trade all the way through the actual earnings release. We are in this potentially, if this is something that you want to engage in, we're in this for the idea that as volatility expands, the value of the at the money or slightly out the money call and slightly out the money put is going to increase as volatility expansion does. Now, the issue with this is that this is a directionally biased trade, right? If it goes up too much, then that's going to help you in one respect and hurt you in another. So in this case, you hope that the stock doesn't move. You don't really want movement out of this. You just want the volatility expansion here. So we came in, we bought one contract of this for $299. Okay, that's the expansion tactic. Now, a thing to keep in mind, this is a high-risk trade because you are buying into this thing with twice the time decay. And what if you have volatility stagnation? What if the volatility has already been factored in so it just stagnates instead of expanding as we get closer and closer? So this is sort of a institutional trade. This is the kind of thing that pros would attempt to do in trying to make a little bit of money on this trade. It's a high-risk trade. That's really it. You've got double. You're buying this thing with all this juiced up implied volatility, and you got twice the time decay. So it's a high-risk trade. But then again, you can't lose more than your $299. So it has a low probability, I'd say, of you experiencing any significant profits trading that way. Okay. So that's an expansion. Let's go one more level and let's go into the volatility contraction concept. Now, the concept around this is that we are going to sell those contracts just prior to the event. So instead of buying and expecting volatility is going to expand and then closing just before the event, we're going to take the opposite side of that. And we are going to sell when volatility is at its highest level. And we're going to anticipate that volatility is going to get sucked out of those, and we're going to have a vol crush post-event. We could do a secured put. Again, that's an obligatory strategy. A covered call has an obligation. An iron condor or butterfly, I'll show you that. But the purest way to trade this, and that doesn't mean it's the best way, it's just the purest way to trade volatility contraction is going to be to do a short straddle or strangle. But again, I want to walk you through the risk of that because it is an unlimited risk trade here. So we've got two on the calendar here. We've got Microsoft and we've got Tesla. Now, just knowing what was going on with Tesla about this point in time and knowing that we had volatility much, much higher, Microsoft also had high volatility, but nothing nearly as high. If I'm going to trade a volatility contraction strategy here, I want something that has as much volatility as expanded as possible, expecting a bigger contraction here. So the first question I'd have to ask myself is how inflated is the volatility premium? Now we're back here again to that Tesla chart. Let me walk you through that again. We're going to compare the current level of volatility to the historical levels and where we're at in the recent range, that is. So once you pull a quote up in Power E-Trade, you can see that in the red box there, I've got the implied volatility rank is 96. Now that's just where it ranks, but the current implied volatility level is 73.35. That is on the annual contract. Okay. Now the 52-week historical, the actual behavior of the stock has shown a 27% to 69%. So the annualized 73.35 is currently higher than anything that had been seen, the price behavior that had been seen over the past 52 years. Now, that's not surprising that that's the case. But what is really quite extraordinary about this earnings announcement is that current implied volatility of 73.35 is on the 1-year contract. But let's talk about the contract here that is the January 31 contract. If you look at that one, that's the one we looked at before, we've got the volatility there way higher than that 73.35. People are willing to pay for the calls and the puts as if the volatility was upwards higher than 165%. And I can see that down below where I've got the implied volatility for the 580 call at 168.29%. And I've got the implied volatility for the 580 put at 168.29. So these options are very, very overpriced based on a Black-Scholes historical model. But that's because historical models don't know what's going on with Tesla, don't know about the earnings and that are coming up in 2 days. So if the thought is this thing is just simply going to revert back to the annualized about 73, that would mean that this thing has almost 100 percentage points overpriced. Okay? So the person sees that and says, I just think people are irrationally exuberant on what this thing could possibly do. Now keep that in mind. Okay, so we look at the bid. We're going to be thinking about selling the call because we think people are overpaying for it. They're being irrationally exuberant. And we're going to sell the put as well. And we're going to, here I am in the order ticket here. I'm going to set up a short naked straddle on Tesla, anticipating that people are going to be wrong. They're overpaying and the stock is simply not going to move that much. Let me walk you through this trade, and I'll certainly disclose why this may not be a trade that you are going to be comfortable with. But it's a good example to explain how these things work. This is a straddle, and we are selling instead of buying in anticipation of a contraction of volatility post-earnings. We're going to sell the 580 call option, and we're going to sell the 580 put option. We're going to capture the bid for each of those, which takes us to a credit of $58.52. That brings in $5,852. Now, that is my credit. If Tesla goes through earnings and the stock stays and closes right at 580 on January 31, then I will make $5,852. The probability that the stock is not going to move any at all is practically zero. So the probability of you keeping the 5,852 is practically zero. So before I move on to the next screen, I want to point this note out. This trade has unlimited loss potential. This is the kind of trade that could blow up in a very, very bad way. I'm going to click Snapshot Analysis, though, and we're going to put this into a statistical model here. You hit Snapshot Analysis, and we're going to go through the maximum profit. I just mentioned that. The most you could make is 5,852, assuming that we hold it to expiration and assuming that Tesla closes at 580.00. Then I would make 5,852. And the statistical model is telling me that there is a 0.03% chance of that happening. In other words, that's not happening at all. Look at my maximum loss, an infinite maximum loss. Therein is a reason that you should think twice or three times about a trade like this, and you certainly could not do this in your retirement account. I will be showing you, I think, a better way to do this, which is going to be the iron butterfly, which will be the next trade I talk about. The maximum loss is infinite. Okay, you can't really put a number on losing infinite money, so that's not available. But look at the break-even point. Because that volatility was so high around earnings, we will make some money if the stock is higher than 521.48 or lower than 638. Remember, the stock is trading right around $580, so we've got all that upside cushion to 638 and all that downside cushion to 521. In fact, there is a 98.8% probability that I will make some money, which really means there's only a 1.2% chance that I'm not going to make some money in that case. So looking at the probabilities might make you rather excited that you're going to make some money. But look at the infinite loss there as well. And Tesla has been known to do some pretty extraordinary things. Well, that's how the trade's set up. Let's fast forward here to the day after earnings came out. The stock is up 61 points. It moved 10.5%. Now, of course, we all know, now that I'm recording this, the first week of March, we all know that Tesla went up over $950 just a couple of days later. But I want to walk through this trade because this is a crash and burn trade, but I want to show you how it didn't hurt as bad as maybe you would think. The stock went up 61 points to 642. If I go back, 638.52 was the upside limit that we'd break even. So the stock, this move that it did was a huge move when it comes to the probability of it happening. Remember, there was only a 1.2% chance that it could move this big. Well, it did, and then it moved even bigger. That's why so many people were absolutely crushed on some of the being on the wrong side of these Tesla moves here. So the stock was at 642.36. Well, this trade did not go well. But let's talk about how much it actually hurt. In order to get out of the trade, I need to reverse the trade. So the call that I sold and the put that I sold, the 580, January 31, I need to buy them back. And I'm going to buy them back for 63.13, right? That's going to cost me 6,313. Well, remember what I brought in on the trade. Let me go back to that. I brought in on the trade 5,852, so I have to give back the 5,852, and I got to give back what? Another $200 on that. Excuse me, let me take that back. 58.52 and 63. I got to give back another $500. So although this trade did something truly extraordinary, I should say, although the stock did something truly extraordinary, you really didn't get hit all that bad for a high-risk trade that had unlimited loss potential. And the reason you didn't get hit very bad in this case is because you sold those premiums that were so rich in the implied volatility. They were so absolutely juiced up. Okay, so that's closing that trade. It could have been much, much worse than this. Okay, hopefully that scares you a little bit, and we'll go on to the next trade here. Okay, so here's the other point about implied volatility. As I mentioned, it often overstates. So here we are looking at Tesla again, and on my chart, on my Power E-Trade chart, I have included volatility, and you can see it right here. We've got the red line, which is the implied volatility, and we've got the green line, which is the historical volatility. So this is a 3-month chart. So 2 months ago, or I should say in the first month of this 3-month chart, the volatility was trading lower than the realized volatility. So people that would have bought calls and puts would have actually been kind of buying them cheaper than what they should have been because the underlying stock moved more than people thought. But for the remaining, every time that the red line is over the green line, that means that people overpaid, that the stock did not make the anticipated move that either the call would have predicted or the put. And this is, of course, very typical that the implied volatility often overstates. So because you look at this and you say, 2 out of 3 months, this thing was overstated on volatility, maybe I am okay placing an overstates kind of trade as we get into earnings. So here's an overstates iron butterfly open trade. Now it looks very similar to the naked strangle or the naked straddle, but here's why it's a much safer position. We're doing an iron butterfly, and you can use the drop-down menu, and it'll kind of pre-build it here for you. And in this case, you are selling pretty close to being an at the money. This one I'm selling the 585. Probably a better example would have been if I would have stuck with the 580, but I was probably anxious to get a screen capture of this. So anyway, We are selling the January 31 585 put and 585 call. So that looks very similar to what we did previously on the trade that blew up in our face. This one's going to blow up too, but just not as bad. But we're going to go ahead and take some of that money, as I like to say. We're going to keep our greed in check, and we're going to protect ourselves. So because we are selling the 585 put, I'm going to use some of that money and buy the 565 put. So that creates a sort of a plan B. What if I'm wrong and the stock does collapse? Well, if I end up having to buy shares at 585, I could always dump them at 565. Well, how about on the call side? Well, I'm going to sell the 585 call, and I'm going to buy the 605 point. Again, another 20-point wide spread. So essentially, I'm bringing in a credit here of $18.02 per share to take on risk of $20 per share. So I'm bringing in 1,802. Now, here's what I think it's really interesting here. I'm bringing in this credit. Now, again, I am assuming that the stock is going to stay contained within a range, but that the premiums have overstated like they have been for the past 2 months. Let's go ahead and walk through the snapshot analysis here. Snapshot analysis is the maximum profit is 1,802, but again, a super, super low chance. That would mean that the stock closed at 585 at expiration, something it's very, very unlikely to do. But look at the maximum loss. The maximum loss is only $198. So even if I'm totally wrong, I'm going to lose $198, which means that maybe I'd be comfortable with doing more contracts now that I have defined the risk associated with this trade. If I think that the premiums are overstated, yeah, then I could load this thing up a little bit more. But it is giving me a 39.5% chance of experiencing that maximum loss. Now look at the range. The break-even range is 566 to 603. So I'm saying to myself, okay, everyone thinks that Tesla is going to do something extraordinary, so they're really paying very high for the calls and the puts. And I'm going to sell to them. And I think, one, they're overpaying. And two, I think it's going to do something that is not quite as extraordinary as these people think is going to happen. That would be my position on setting up a trade like this. And you can see, if we go to the risk metrics, by the way, you would do that by hitting the Analyze and Trade Lab, and you can look at the various risk metrics and the what-if components of that. What happens? What's the price sensitivity like? Does it like higher prices or lower prices? Well, it currently likes higher prices, but only 9 cents. So it's not very sensitive to price movement. How about time decay? Every day passing is $90.56. This thing is very sensitive to time. Unfortunately, time only moves forward. So every day we move forward, you sort of build a cushion around you a little bit. And then look at volatility. It's also pretty sensitive to volatility at $1.24. And again, this is that Vega that we talked about. So if I anticipate that Tesla is overstated and it's going to revert to the mean, and that the option pricing is going to go from being priced at, 170% implied volatility, all the way down to sort of its mean, which would be about 70%, then that $1.24 for every 1% change is going to play into my favor. And then, of course, the bottom one there is interest sensitivity. I don't think interest rates, we're going to change in that 2-day period, and it wouldn't really matter anyway for a 1% change. Okay, so we've got the iron butterfly on. Well, how did the iron butterfly work out? Well, take a look. Here's the stock. 645, it went up 11%. So because the price did something so dramatic, yeah, we absolutely lost on this trade, but look at what the implied volatility did. It did exactly what we thought it would do. This is the vol crush, and it reverted to the mean. Not quite. Take a look. It went from whatever it was up there at like 170 all the way down here to its current levels, and you can see down below that it's now trading with a volatility of about 70%. So it's reverted back to the mean. So we were absolutely right on the behavior of the volatility after the earnings came out, but we were absolutely wrong about the magnitude of the move. As such, because the magnitude of the move was so great, we're pretty much at maximum loss here. So to close out the iron butterfly, what I sold I need to buy back, and what I bought, I need to sell. And I'm doing that for 1,940. Now, if I go back here, 1,940, let's look at that trade real quick. 1,802. So of the 1,940, well, 1,800 of that was the credit that I got. So indeed, I hit maximum loss. So using an iron butterfly really allows you to, if the stock had done something less extreme as far as the movement, let's say that it had only moved to $600, then there would have been some profit in here. Granted, it would not have been anything super impressive, but then again, it was a smart trade when it came to the volatility. But who would have predicted almost an 11% move to the upside? Apparently, the people buying the calls made that prediction, and they were accurate in that one. Okay, so close that position out. So with some takeaways here, hopefully you're understanding more about the volatility and how it relates. Now, again, if you have an opinion, I hear people say all the time, hey, I think they're just absolutely going to rock earnings, and what should I do? Well, it's pretty simple. If you think they're going to rock earnings, then you think the market's going to react positive to that. You think the price is going to move higher. Then you have to go and look at call options, and because those things are so juiced up because of that expansion of implied volatility, be sure that your prediction allows for that kind of a big move, or the big cost of buying that call option, or put option if you think the big move is going to be to the downside. So there's no perfect trade when it comes to trading earnings, but very often earnings create an opportunity to utilize some of these more volatility-based trades than strictly directionally based trades. So one of the ways that you can do this is to go to eTrade.com and go to the complete view. And on the right-hand side, you're going to see Power eTrade. Of course, I encourage you to utilize that platform. But while you're getting familiar with that, you can use the Power eTrade simulator, which is called paper trading. You've got $100,000 of fake money in there. It's simulated data. You can go in and mock up a few earnings-based trades, and again, you can find that earnings calendar on Power eTrade as well. And hopefully, this will help you to better understand what's going on with these volatility-based trades around that. And then, please do continue to learn. If you go to eTrade.com/events, you'll find many other webinars that we've done on everything from technical analysis, retirements, to, of course, options.